Welcome. This is Olivier Wagner from 1040 Abroad. You can reach me at 1040abroad.com. I want to present this video to discuss the impact of Joe Biden's tax plan for Americans overseas, those who plan to renounce US citizenship, as well as those who stay in the tax system. We are all thrilled to have a new president, and many of his measures will make the world a better place. Some will have a negative impact on American overseas, especially those who plan on renouncing US citizenship. So I will discuss the impact it has on US citizens planning on renouncing will increase US citizenship, as well as other points that would impact, for instance, US shareholders of a foreign corporation. So to back up a little bit, some people who renounce US citizenship would be covered expatriate, others would simply be expatriate. Or would someone become a covered expatriate? In most cases, they would need to meet one of three tests. That's an or. So if you meet one of these three tests, you would be a covered expatriate. There are some exceptions for people born with dual citizenship who remained a tax resident of their other country of citizenship, as well as for people who renounced before the age of 18.5 years old. But by and large, these are the three tests. If you meet one of these three tests, you would be a covered expatriate. The first test is the asset test. That is, if your net wealth is worth more than $2 million on the day you renounce. The second test is the income tax test. That would be if your tax liability was over $168,000 as of 2019 over the prior 5 years. So you would look at your income tax liability after foreign tax credit, and you would look at the numbers over the prior 5 years. You would average it out. If it's more than that number, you would meet that test. It's worthy to note it's only income tax. It doesn't include self-employment tax or the net investment income tax, only regular income tax after foreign tax credit. Or the compliance test, which is why if somebody wants to contact me to renounce, I would advise them to file 5 years of tax return, because they need to certify that they've been compliant for the 5-year period prior to renouncing in order to avoid covered expatriate status. So with that in mind, most people, if they are to be covered expatriate, would be because they meet the asset test. People who owe that kind of income tax would also have that kind of assets, and with proper planning, people would meet the compliance test. They would be compliant and therefore would not be covered expatriate by virtue of not having filed tax returns. So what do people do when they have more than $2 million and they want to avoid covered expatriate status? One of the common strategies is to gift the excess assets either to a spouse, a children, or some other people that they trust or wish to gift money to. And as such, they would gift the money before expatriating, and on the day they renounce, they would have less than $2 million of assets and therefore wouldn't meet the asset test. So the US has a gift/estate tax system, which allows someone, a US citizen, to gift up to $11.58 million during their lifetime without incurring a gift tax. They would still file Form 709 reporting the gift if it was more than $15,000 in any given year, but they would not be subject to an actual gift or estate tax. So that's the first proposal that Joe Biden has. It would be to reduce that lifetime exemption from $11.58 to, he hasn't given an exact number, but it seems like it would be about $6 million. So to the extent that you would want to make gifts in order to reduce your asset base to less than $2 million, that might cause you to have gift tax owing. And then if you actually are a covered expatriate and you're deemed to have sold your assets. So that's one of the two disadvantages of being a covered expatriate. One is that you will have a deemed disposition of all of your assets. It's as if you sold them on the day you announced, and then you would be subject to capital gains. Another one is that if you make gifts or someone, a US citizen, inherits from you after you announce and become a covered expatriate, they will be subject to a 40% gift tax. It's the only situation in which the recipient pays the gift tax. But back to the capital gains rates, currently, capital gains have a favorable tax rate of 0, 15, or 20%. In most cases, it's 15%. Was with Biden's proposal, it would rise from the current 15 or 20% to graduated rates, which would rise to 39.6% for those earning more than $400,000. So those were the main considerations for those renouncing. For Americans living overseas, if they don't renounce, if they own a foreign corporation, there's a complicated set of rules that cause some of the income that stays within the corporation to be taxed to the shareholders, even if no distribution occurred. So SEPAREF income has been around since the 1960s. The Tax Act passed by Trump in 2017 also created a new category of income that will be taxed to the shareholder. Even if it's not distributed, it's called gilt income. So it created Section 250 election, which was originally only meant for corporate shareholders. We managed to get it to be applicable to individual shareholders as well, and it will reduce the amount of gilt income that is taxed by half, such that it will effectively be taxed at 10.5% as opposed to 21%. Biden, in his proposal, would remove this Section 250 election such that the effective tax rate would be back to 21%. Another way to avoid gilt income and SEPAREF income is if you live in a country which has an high tax rate and you pay more than 90% of the highest US corporate rate, then since you already paid so much to this foreign country, you will not be subject to SEPAREF and gilt income provisions. Well, currently the US corporate tax rate is 21%, meaning that 90% of that would be, is currently 18.9%. If you pay more than 18.9% to a foreign country, SEPAREF and gilt income provisions don't apply to you. Joe Biden plans on increasing the highest US corporate tax rate to 28%. As such, 90% of 28% would be 25.2%, and you would need to pay at least 25.2% to a foreign country to take advantage of that provision, which is significantly more than 18.9%. Lastly, another consequence of Joe Biden's tax proposals is that he would eliminate the stepped-up basis at death on inherited property. So currently, if someone, a US citizen, inherits property, the stepped-up basis will take place, and their basis, the basis of the person who inherits the property, will be the fair market value as of the time of the death of their parents or who that person was. As such, they would only be subject to capital gains on the unrealized gain between the fair market value as of the time of that person's death and the time they sell it. Whereas if the stepped-up basis is removed, they would be subject to the capital gains on the entirety of the gains from the time it was purchased by the original owner from the time it is actually sold, which if the holding period was several decades or so, could be a significant amount. All right, that was my brief introduction of the the impact that Joe Biden's tax proposal would have. Feel free to contact me if you have any questions. I look forward to preparing such videos in the future. Thank you so much.